A lot of you have asked me about Enphase stock, and this is a stock I've done many videos on, and now it's sitting at $122 per share. It bottomed, looks like it has bottomed around the low 80s, 81, $82, now sitting at 121. And the question is Enphase right now an amazing buying opportunity? I mean, the stock used to trade pretty close to $340, or is it still some kind of a trap, some kind of a value trap, or some kind of a growth trap, where the company might actually keep declining in revenues, which is going to make the current multiple even more expensive than it is? This is what I'm going to discuss in today's video. Now, most of you are familiar with Enphase. They're mainly popular for the microinverters within solar, which I have to admit is an area that I'm not an expert in, which is why I'm trying to focus more on the fundamentals and the value proposition and the numbers within Enphase, instead of trying to assess the competitive edge and the market and what kind of competitors they have and the business model. Most of you know the business model, you know what they sell, you know what they have. They have expanded way beyond the inverters, and they used to, in 2019, they had around $2,000 per home in terms of the capacities they can sell. Now it's $12,000 per home because they expanded into batteries, fuel cell, many other things, which is very important stuff. Now, in terms of the last earnings report, it was absolutely horrible. I mean, Q4 of 2023 compared to Q3 of 2023, quarter over quarter, revenue went from 551 million to 302 million. They had an operating income of 117 million. Now it turned into an operating loss of $10 million. I mean, very, very bad, even if you compare it to 2022, which is not a good comparison. But in 2022, they had 156 million of operating income, and now they are actually losing money. Earnings per share went from $1.13 to 84 cents to 15 cents per share. I mean, absolutely horrible quarter. And the sad news is that it's about to get even worse, because in terms of Enphase's own guidance for the first quarter of 2024, they are guiding 260 to 300 million. So it's going to go down from 302 million, potentially as low as $260 million for the first quarter of 2024. And this is very, very bad. And I have to admit, normally whenever I'm buying a stock, I try to avoid companies that are declining in revenues, because once the revenue starts declining, it normally starts getting downgraded, and then things start to happen and revenue declines even more and more and more. And if you bought it any multiples that look cheap, and revenue declines even more, so multiple gets much higher in terms of forward earnings, and you would have overpaid. So always, whenever I see a company declining in revenue, like more than 2 quarters in a row, I try to avoid it, and I try to wait on it. And once things start to improve, maybe the stock goes up a little bit, then I tend to buy it and ride the trend up instead of being on a downward trend. But if you do time the bottom on something like Enphase in terms of earnings, you could potentially make a lot of money. And the CEO is calling the bottom for the first quarter of 2024. He sees a bottom in the first quarter this year, and then will start to recover in the second quarter. This is what the CEO said. He said utility rates are going up, interest rates are not going to be staying the same. And I agree with him, but we still have inflation, not just in the United States, but in Europe. And it will depend a lot on what the ECB and the Fed decide to do. The Fed here in the United States, they are projecting 3 rate cuts, but a lot of Fed members are now saying if inflation stays elevated, we might see no rate cuts. And a lot of people do finance these projects in terms of loans that gets them, and they have the solar projects on their homes. And if you have higher interest rates, a lot of people cannot afford to do that. And we have a weaker economy in the United States. I think it's also a little bit in Europe, but especially in the United States, weak economy, a lot of retailers and basic needs, even restaurants have been struggling, convenience stores. So this is not good at all. And I'm not sure if I can trust the CEO on that, but this is what he's seeing. He's seeing a bottom in the first quarter and an improvement into the second quarter. And I hope this does happen. Now, in terms of the red flags, I'm going to talk about a few red flags for Enphase before I give you my fair value and my valuation model. The first red flag, not the first one, you could say maybe the second one, after declining revenues, is mainly increasing inventories. This is not good at all. It's something you don't want to see. Nike had the same thing before, and a lot of retailers, some solar stocks do. But Enphase is starting to see a massive increase in inventory. And the CEO said one of the reasons why the first quarter is so low is because of some delayed shipments because of inventories. I'm not sure how it's going to work out, but inventories are increasing, and this is not a good sign for any company, but especially for a company like Enphase. The second one is many of you are looking at the forward PE ratio, maybe on a screener like Ticker or some kind of other stock screener or stock analysis platform. And normally these platforms, whenever they have forward earnings, they mean forward normalized earnings, which is non-GAAP EPS. So there's a huge difference between GAAP and non-GAAP for a company like Enphase. If you're looking at 2024, the expected EPS or earnings per share normalized is $3.33. But GAAP EPS is only $1.73. This is a massive, massive difference between the two. So if you're looking at a very low multiple on normalized earnings, and if you use it on GAAP earnings, it's going to be very, very different. Even for 2023, it was the same. The EPS normalized was $4.41, but GAAP earnings is $3.08. And this could be to various reasons, but it's mainly within these stocks and a lot of tech stocks, it's mainly the stock-based compensation. You could see it with Snowflake. A lot of you asked me about Snowflake. Snowflake is crazy in terms of stock-based compensation, and it's massive for Enphase. It has been increasing a lot, but the good news is it looks like it has stabilized into 2023 and is starting to come down. And in terms of shares outstanding, they have been relatively the same or even trending a little bit lower in 2023. And this is thanks to Enphase buyback program, which is offsetting the dilution. So a lot of you told me in the comments before that Enphase is buying back stock and this is going to create value for shareholders. Well, maybe not. Maybe Enphase is just offsetting the dilution that you're experiencing from stock-based compensation. So of course, shares being the same and going down is way better than them going up, like with many different stocks that have massive stock-based compensation. But still, it's not the regular buybacks that you would get, not the buyback effect that you would get if you're buying something like Chevron or something like Berkshire Hathaway or even Apple. For that matter, maybe Google is a little bit similar to that. But in terms of Enphase in general, it's well prepared to weather the storm. They have $288 million of cash. They have around $1.4 billion in marketable securities. So cash and cash equivalent is pretty close to $1.7 billion of cash. They do have a little bit of debt, around $1.3 billion long-term debt, and they can easily afford to pay it off, and they can afford to pay off their current liabilities if they have to do so. So the balance sheet is clean. They have some cash position, and this is going to help them a lot in terms of weathering the storm. Now, in terms of the valuation model, I have to admit, this is one of the hardest stocks to value in the stock market because earnings are extremely, extremely volatile and they just keep trending lower. Like if earnings were starting to trend upward and the CEO guided for an improvement in Q1, I would have been much more comfortable using certain valuation models. But it's extremely, extremely hard to value Enphase because no one knows where it's going to be. It's kind of like trying to value ALB stock or a lot of the lithium stocks. I mean, you don't know where lithium is going to be and you don't know how to value these stocks. Very, very hard to value. And Enphase is very, very hard to value because we don't know when the cycle is actually going to bottom. It's going to depend on inflation. It's going to depend on interest rates, which we can't control. It's going to depend on many different things. So anything I say in the video, and I think anyone that's putting a valuation model on Enphase is mainly speculation, and it's not something that I could take with certainty. But the simple way I look at something like Enphase, they are guiding an improvement in 2024. And this is what the analysts have. They do have some kind of improvement later after the first quarter. They have the first quarter as very low net income, and then net income is going to improve. So in total, for 2024, it's expected to be around $460 million, way below what it was in 2023. And in terms of an earnings multiple, the company is currently trading around 30 times earnings, which I believe is a little bit excessive. This is 30 times normalized earnings. So if you're using GAAP EPS, it's like maybe 50 or 55 times, which is extremely, extremely expensive. But the stock did trade at a mean of 50 times earnings. But this is back then whenever Enphase was at its prime in terms of growth. So I believe 30 times earnings is honestly a little bit expensive. Now, before this whole thing happened, the company was trading around 24 to 25 times earnings. And even 25 times normalized earnings, I still believe it's somewhat expensive. But there's a lot of optimism priced in Enphase in terms of recovering for growth and net income. So I'm just going to use a basic 25 times earnings, even though I believe it's expensive. So all I'm doing here, I'm taking the 460 million of expected net income, which I believe is a fair number, and I'm timing it by 25 times earnings. This is $11.5 billion market cap. If I take this $11.5 billion market cap and I divide it by the total shares outstanding, which is 143.29, I get something pretty close to $80 per share. So for me, if I wanted to go based off a conservative estimate, if we do believe that 2024 is the bottom, and if we don't believe that 2025 is going to be a massive improvement, if we just think like the worst case scenario is 460 million, and Enphase is never going to grow from here, an absolute pretty much bottom case scenario for me, or a very conservative case scenario, I would be willing to buy Enphase around $80 per share, which is exactly where the stock bottomed. Now, I have to say, maybe Enphase is not going there, and this is an extremely conservative case scenario. But if you're a very long-term investor and you're speculating and you believe that Enphase is going to make a massive, massive recovery, and net income per share or net income in general is going to improve massively and everything's going to be fine, like if Enphase does get to 1.3 billion and you use 25 times earnings on that, this is massive upside potential on the stock. So this is what I think of Enphase. It's extremely speculative. For me, I normally don't like to take such risks. If you're someone that takes a lot of risk, I think Enphase could be an amazing buying opportunity. I mean, for me, I would not be surprised if the stock has most likely bottomed and is likely heading up because of where it was and where it is and all the bad sentiment, and things should be improving in 2024 with potentially the Fed or the ECB cutting rates. So the stock could have bottomed. But if I'm a very conservative investor, I would not be willing to pay more than $80 to $85 per share on Enphase, unless Enphase, of course, massively surprises to the upside in terms of estimates and things improve massively in Q2 of 2024. But if they don't, I mean, I could easily see Enphase going back to $80 per share. This is just my honest opinion on Enphase. That's what I think about the stock. It's extremely, extremely uncertain, extremely risky. So I hope you enjoyed the video. It wasn't financial advice. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.